Hi, welcome to Challenge JP. My name is Jacek, and today I'm going to show you how to create a real estate investment model in Excel.
Okay, let's start from the general structure and main assumptions that will be used in this model. So as you will see, I'm assuming that I'm building a number of properties, and the model then allows to use those properties either for direct sale or also for rental. So that's where the model starts in here. So you see the number of properties that are completed. Then of those properties, you will see a number that will be available for rent, the number of that will be sold. Then the model goes into the calculations of revenues, then direct costs. So any costs that are directly related to managing or selling the properties, they exclude all the capital expenditures, so all the build costs, which the model will deal with at the later stage. Then there will be some calculations around the employee costs and the general Opex. So we will assume that you need to have some number of people to manage the properties or to manage the sale of the properties, and then some general expenditures. That will lead us to the calculation of EBITDA, which is the earnings before interest, tax, depreciation, and amortization. And then there will be some tax calculations related to sales and the rental of the properties. And then here we'll proceed to calculation of a build cost for the properties that are aimed to be sold or rented, a bit of a working capital, then finally the calculation of cash flow unlevered. So any cash flow that is resulting from our assumptions before we insert any debt calculations. And then later on, we'll focus on debt. So the model allows you to inject to finance some of the build, a percentage of the build with debt. That then will be followed with the debt repayment calculations and also interest and any fees related to the debt. This will then result in the calculations of cash flow levered. So levered being the cash flow plus any net effect of introducing debt into our model. And then you will see below that I've also included some statement such as P&L, also cash flow, a detailed cash flow statement that's divided into operations, investment, and debt financing, and then finally the balance sheet, and then calculations for equity investment return analysis. So the calculations of return on any equity that you need to inject in the model. Okay, so that's the main structure of the model. And then you'll see that on my right here, I've also included the assumptions table and then some summary of the key metrics. So the model has assumptions around the number of properties. Then there was a split between the number of the percentage of properties that you want to use for sale or for rent. Again, you may assume that you only want to use this model to sell properties or only to rent, or mix of the two. So this is where you can determine the percentage of the properties that will be either sold or rented. Things around a build timeline. So for example, how long it will take you to build those properties, and also when you will complete your first property. So you may assume, for example, if you have a larger number of properties that you want to build, so if it's a bigger project, you may decide that you can actually, some of the properties will be completed before the end of the project, and therefore you can start already renting them out or selling before the entire project finishes. So this is where that first completion comes in place. And then there were some assumptions around the average build of the property. I've also included some annual increases to account for any inflation or any increase in cost of the material, as well as open market value of the properties. So that metric will be important to calculate the later on the rent, and also we'll use that as a basis for the for rent, and therefore also as a basis to calculate the yield, and the yield will be used for the valuation. Again, some assumptions around the increase, the percentage increase in the property value over time. Also some assumptions around the cost. So this is where you also have increases in the consumer price index, which influences the cost. And then there were some specific assumptions to sell and to the rental of the properties. So for example, assumptions like how long it takes you on average to sell the properties from when the build of the property is completed to when it's actually sold. Some assumptions around the direct cost. So the cost per sale of the property as a percentage of the revenues, and also a sort of fixed cost per property sold. For example, any legal fees or any other commissions that you may have to include in your model. Then we also have calculations of the rental for the rental of the properties. So for example, you have that yield assumption, which then determines the level of rent that you will charge in your month one. And that is linked to your open market value of the properties. Also, some other assumption as to, okay, how long it will take me to rent my property from when it's finished. Assumptions around the minimum rent, and then the average maximum rent period. So this is how long your average tenant will stay in the property before they move out. That assumption will influence the calculation of occupancy rate, which we'll get to in a few minutes. Assumptions around the on-time payments, and then also rental costs. So any maintenance, any other direct costs, or any renovations, or any expenses that you have to include in order to calculate the net income that you receive from those properties. And then there are some assumptions around the salaries calculations, so staff cost, so the number of employees that you need to hire in order to manage your office. And then also there are some assumptions around the headcount that you need to assume in order to manage the properties. And then there are some salary assumptions, and then the central cost office calculations. Okay. Now, to the right, you also will notice that I've added some debt financing assumptions. So as I mentioned before, the model assumes that you can finance some of the build cost through, for example, a loan from a bank. That's where you can set the percentage of the build cost that will be financed through debt. Also the terms, so how many years you're going to be paying that debt over, interest rate, annual interest rate, and then any one-off fees associated with drawing the debt. Then there are some other assumptions around the depreciation for the sales properties and for the rental, tax, also whether you can deduct the interest from a tax calculation, and then finally assumptions that we'll use for valuation. So those would be the yield assumption and the discount rate. And then you'll see at the top here, I added some key metrics, such as an equity requirement that you will need to fund the model, IRR, so the rate of return, NPV, and then also some totals for revenues, EBITDA, and cash flows, and also the same metrics on a per unit basis. Okay, let's jump into the monthly cash flow forecast calculations. So the way I structure this model is I start the spreadsheet with the main metrics, the main inputs, and then I divide the cash flow forecast into the sales part and then the rental part. So those are separate cash flows that then we'll aggregate them together on that summary page that we just look at. And also, in addition to that, you will see that I've added those debt calculations. So you will see exactly how the debt is calculated. And then there are some calculations for tax and depreciations that will be needed for P&L and for the balance sheet calculations. Okay, so starting from the top, start with listing the number of addressable properties. So the number of addressable properties will be the properties that we're planning to build over time. You see that I have a timeline here. So this is my month number, and then also the month and the year, and then also split separately the year and the month. Here I have my build progress. So remember when we set the assumptions in the summary page over here, one of the assumptions, for example, was the number of months over which you will complete your build, and you will see that that number is listed here in my left column. So what I did in this model, I basically made sure that all the main assumptions are listed either to the left, or they're also listed on the monthly basis in the model itself. So you don't have to, and you see that there's a link to my summary sheet over here. So you don't have to switch back and forth between the sheets in order to understand what assumption is being used. But the idea is that still, in order for you to change the assumption, you have to go to that summary sheet and then change any of those yellow cells, okay? Right, so going back to our calculations here, so we know that, okay, we want to build 120 properties. Now build progress is just basically calculated, it's based on that 30 number, so we want to build those properties over 30 months. So you'll see that that number here is going towards 100% over time, and this will be driving the build cost, which we'll get to in a few minutes. And then you also have the number of the percentage of properties completed. So if you recall, one of the assumptions in the model is an ability to set when the month at which the first property will be completed. So for example, if you're building 120 properties over 30 months, you may decide that actually the first property will be ready to be for sale or ready for rent after, for example, 12 months, right? So you don't have to wait until the entire project is completed. And that's exactly what you see in here. So if we go to a few rows below, you will see that's the number of properties completed, which is simply that 5.6% times that 120 properties, which gives us 7 properties that are completed. Over here, we have the number of incremental properties, so the new properties completed in a given month. As you see, as we're progressing, 7 becomes 13, 20, 27, and so on and so forth. And then this total number of properties is split between the properties for sale and then for rent. Remember, we had the assumption for the percentage of properties that are for sale and the percentage of properties that are for rent. So with those main inputs, we can now proceed to the cash flow forecast for sales. So you see that starting here for sales. It's a relatively straightforward forecast. So first of all, we're starting with the open market value, average open market value for a house. And I listed those inputs here on a monthly basis because they do, we have introduced the increase in the value of the house over on an annual basis. So for example, at the moment, the model is set to a 3%. So you'll see that 240,000 increases by 3% every January. And that's what that index here is telling us. So the way the model works is just take that 240,000 and then multiplies that by this index to increase it to appropriate value. So that's our market value of the house. And then one thing that you'll probably notice is that there was a bit of a gap between when the number of properties were completed and when they were sold. That's driven by that 3 number here. So there was one of the assumptions in the model was the gap, was the time it takes from when the property is built to when the property is sold. And that's exactly what happens here. You see there's that 3-month delay. So that 3 comes here, and then that 4 properties come here, 5 properties come here, and so on and so forth, okay? Now, in terms of the calculations for the revenues, so the sales proceeds is a very simple calculation where you take the average market value of a house, and then you multiply it by the number of properties sold, okay? So if you sell 1 property, the average market value is 247,000. That's why that's your revenue or proceeds. If you sell 2 properties, you just multiply that number by 2. Now, in terms of cost calculation, you will see that the model assumes two methods of calculating the cost. One is the percentage of revenue. So let's start with that. See that I'm saying that, okay, well, let's take 6.5% and then multiply it by the revenues that you generated from the sale. And that's going to go into one part of the direct cost. And then the other method is to simply say, okay, well, I'm going to take the number of properties that I sold, and then each property has a fixed a dollar or pound or whatever currency you're using for that model value. So for example, in this case, what we're saying is that every sale will generate 2.5 thousand, let's say, dollars in fees. And then in addition to that, I've also added a bit of an inflation. So you'll see that that number here is not 5,000, which will be 2 multiplied by 2,500, but it's 5.1 thousand because I have an increase here of 2%, right? So I'm also increasing whatever the base number is in the assumption. I'm also applying a bit of an increase, and I do it through calculating that index, which is linked to that 2% increase that we put in the assumptions. And that number then gives me my gross margin, which is simply the my revenue minus my direct cost. Okay, so that's the margin that I generate from my sales. Okay, and then moving down here, you see that now I need to also include the cost of bill calculations. In this case, I have an assumption here as to how much it on average costs to build a property. And in this case, this number is linked to that build progress percentage number. Okay, so I know that, okay, I've, let's say if we're looking at May 2024, I've increased my progress from 53.3% to 56.7%. So I can now, the formula calculates what's that incremental value. So that's about 3.4% in terms of my progress. I know that I now take that number, that incremental number, multiply it by number of properties in total. I know how many of the properties were allocated for sale. And then that gives me the number of properties that I've completed for sale, and then I can multiply that number by the average cost per property. Okay, and then below we have a bit of a working capital calculation, which basically deals with any delays in either receiving the payments, the revenues, or any payment from our side in paying the bills. And that section concludes with the forecast, which is the sale cash flow before financing. So this is forecast for any cash flow before we receive any financing or any loans from a bank. Now let's move to the rental forecast. Total properties that have been rented allow me to calculate my occupancy rate, which is simply the number of rented properties divided by the total of properties available for rent. That 26 number is linked to the number here, number of properties available for rent. Now, this calculation can be a little bit complex. The idea is here to give a bit more precise numbers to your occupancy rate, which will be quite low at the beginning of your model, and then you'll see it grows towards predictable number of around 95 or so percent. That number is also driven by your average rental agreement. So if you recall, there was an assumption in the model where you can set the number of months, the minimum number of months and the maximum number of months on average that the tenant stays in the property. That's where you see that share number coming in here, which is just the number of people that are leaving the property. And then again, there's a bit of a time in between the time when the tenant leaves to when they come back. You can either use a bit more precise calculation like that, or you can simply assume, you can set the occupancy rate, for example, at 95% or 98%, and just calculate the number of rented properties taking this number and multiplying by the number of total properties available. But just bear in mind that you may need to show that at the beginning, when you're releasing the properties for rent, there may be a time from when you get to that target level of occupancy. Okay, and then so based on those numbers, we know what the open market value of the properties is. That's the number that we used before when we were calculating the proceeds from sales. We also have an assumption for the yield that you will generate from your properties, and that allows you to then calculate the monthly rent. So the way that the model calculates the monthly rate is by taking the open market value and then it just multiplies by the assumed yield, and then it divides that by 12 because we want to have that number on the monthly basis. You could potentially just have an assumption around the monthly rent without that calculation of yield times the open market value. But the nice thing about that yield calculation here and that value is that as the property value increases, so the average rent, right? So those two are linked, and it's one of the methods that you use to estimate the potential level of rent that you can receive in a given market. Now, I'm also estimating some direct costs here. So similar to what we did with the sales cash flow, we can estimate some of the cost as the percentage of the revenues. So for example, you may decide that you want to allocate a percentage of your revenues into maintenance. There's also some fixed costs. So for example, the model here assumes that every time you have to rent a property, there will be some marketing or acquisition cost. So any costs relating to advertising the properties, or for example, any fees that you have to pay to an agent if you're using one. Then there will be some other direct costs. So those will be monthly costs, for example, like service charges, which in this case, it just simply takes the number of properties rented times that cost and then applies a bit of an inflation on top of that. And then if you later on have to re-rent your flats, your apartments, you'll see that there will be an assumption here that allocates some cost to the properties that you have to let. So that gives you your total direct cost. And then if you take the revenues and you subtract from those revenues those direct costs, you will see your gross margin. Finally, I'm also assuming that for your rental business to work, you need to maybe have an office, probably hire some people, depending again on the size of your company. So the way the model works, it assumes that you have a central office, which is basically fixed. So for example, here we set 2 employees at our central office. And then you also have headcount or employees, which I call operations. So those will be people, for example, that have to manage or maintain your properties. And in here, the way that model works is that for every X properties, so for example, in our case, for every 50 properties, it assumes that you have to increase your number of employees by 1. Okay, so that number here is more variable, it's driven by the number of properties. Then I also have some assumptions around the average salaries, which are increasing with inflation over time. And that then leads us to calculation of the staff cost. So that's the number of, for example, your headcount in central office times your average salary. That gives you your staff cost for the central office. And then the same thing happens for the operations or your maintenance. And this gives you your total number here. And then you also have some operating expenditures in here. So for example, your office, which is actually in this case driven by the number of employees that you hire, and then other expenditures, for example, like IT, any monthly expenses, and then also put some contingency here, which is just the percentage of your revenues that you would allocate to other expenses. That gives you a general OPEX. And then finally, you can calculate your rental EBITDA, which is your gross margin minus your staff cost minus your general OPEX. You also have some tax calculations. And then finally, the calculation of the bill cost. The bill cost here is calculation is done in exactly the same way as it was done for the sales of the properties. So it's simply taking the number of properties using again our bill progress percentage. So for example, in this case, we know that from October to September, we've added 3.3% of the target of the properties, which is 120. And then of that number, we need to allocate 80% for rent. Then I need to multiply this number by my average build cost per property, which in, let's say, October was 200,000. So that gives me my 640,000 figure, which I need to allocate to CapEx. So your EBITDA adjusted for any tax, then CapEx, and then the working capital gives you your estimate of the cash flow before financing. So that's again the financing that you will get before you receive any debt. And then finally here, I'm just summarizing those two cash flows together. So the cash flow from sale and the rental, which then allows me to start calculating my debt. Okay, so you see that I've listed here all the debt that you will receive, any debt repayment schedule, interest and fees that are associated with this debt or with these loans, and then finally this allows me to calculate the cash flow, the levered cash flow, or the cash flow after the debt financing, right? So that you see there's a bit of a difference here. For example, this is your cumulative cash flow before you receive any debt, and this is your cumulative cash flow, so your deficit after you receive the debt, right? So your 5.6 million becomes 1.3 million of deficit because the rest is financed through debt. Now let's very quickly look at the debt model, which is over here. So you will see that I have a debt model here for my sell properties and rental properties done separately. So the debt model here is relatively straightforward. I'm assuming that my build costs can be financed through a loan at, let's say in this instance, 80%. Again, it's one of the assumptions that you can set in the model. So for example, if you see here, I'm assuming that I will have an incremental build cost of 160,000 say dollars, which is financed at 80% through debt, right? So you'll see that just listing the main assumptions or main basis of calculations. I need to know, okay, well, how much money I spend for build in a given month, and then this then allows me to calculate the level of debt drawn. I included here a debt schedule, so you can always see the opening balance for your debt, which is simply the balance, your closing balance from the month before, and new debt that I'm adding, which is that calculation that we just covered. Any early repayments of the model. So in case of the sales of the properties, not the rent of the properties, but of sales of the properties, the model will assume that, for example, here you start selling some of the properties that you draw the debt against, which means that the moment you receive the proceeds from the sale of those properties, you also have to repay any debt that was associated with those properties, because you can't secure your debt against them. Therefore, you have to repay your debt earlier. And then in addition to that, you also have your regular principal repayments, which is a difference between this figure here, where I'm using the PMT function in Excel to calculate the level of payment that I have to make in order to repay my existing debt balance plus any new debt over a period of time. So my principal repayment would simply be my total payment minus my interest. So in order to get to my closing balance, my debt closing balance, I just have to take any opening balance plus any new debt, and then from that figure I have to subtract my principal repayment. Okay, that gets me my closing balance here, which gets carried over to opening balance. Then again, I'm adding additional debt. Then I adjust it for any early repayments or any principal repayments, and that calculation continues. The same logic follows for my rental debt. So you'll see that now I know, okay, what's my build costs allocated to my rental properties. For example, in this month, in August 23, it's 640,000. Therefore, I'm assuming that I can take 80%. I can take 80% of that figure and finance that through debt. I don't have any early repayments. In fact, in my rental model, I won't see any early repayments because we're not selling any of the properties. And then again, I can take any of the figure allocated to a principal repayment and deduct it from that opening balance and any new debt that I injected, and that gives me my closing balance. Yeah, and again, for interest calculation, I'm just taking my opening balance plus a new debt, multiply it by my interest rate, which is in here, and then divide by 12, because again, everything is done on a monthly basis. That calculation here, the total rental debt service, that's the calculation that allows me to calculate using that PMT formula, Excel formula, the total level of payment that I have to make in order to repay the debt over a set period of time. So in this case, we're saying that we want to repay that debt balance over 353 months. Remember that in the assumptions that we made, we assume that the debt will be repaid over 30 years, and that starts counting from when we draw the debt for the first time. So you see that the number of repayments are decreasing over time, going towards zero over 30 years. So that's the number that we're going to use in that PMT formula, which is here. So the PMT formula takes the rate, the interest rate divided by 12. Then the NPR figure is the number of payments that we have to make. So that's 353. And then the PV value, which is here, is just simply the amount of debt that we want to repay, which in our case would be any opening balance plus the new debt. So that PMT figure gives me my total payment that I have to make. And then in order to calculate that principal repayment, I just have to subtract the interest from the payment figure and then allocate the rest to a principal repayment. And then similar to our sales loan, I also have to allocate some amount to one-off fees, which is simply taking the percentage. So in our case, 1.5%, and then multiply it by any new debt that we have drawn. Okay, and then those figures here, this debt model then fits into the debt financing cash flow figure, which is over here. Okay, and then that allows us to calculate the levered or post-debt financing cash flow. Let's go back to our summary page. So you will see that all I did in here was to consolidate all the figures from my monthly cash flow into an annual view. You see that I slightly changed the format in the view. So I've aggregated all my revenues in one section, the costs, salaries, general Opex, tax, capex, and so on and so forth. But I will get to exactly the same figure as we got in our monthly cash flow model. So you see there's the same cash flow, unlevered cash flow, and then the post debt financing or levered cash flow in here. Now below, I've also included a profit and loss summary, which again lists the revenues and costs in a similar format, but then I've also added some depreciation calculation, and then also listed the interest below my EBITDA here and all the debt fees and tax, so I can calculate the net income. You'll see that the depreciation calculation are linked to also cash flow model here. That's the section over here. So because we're dealing with asset-based model, I mean, you will have a quite significant capital expenditures or build cost in your model. You have to make sure that you will also include depreciation calculation in your forecast. And then that allows me to calculate my net income. Then I also have a cash flow statement. So you have cash flows from operations, where which you'll see that detailed calculations for here. Then there's also any cash flow from investment. So you will see that those are the your capital expenditures. So any money that you spend on build, but also any proceeds that you receive from sales. Okay. So for example, in the case of rental properties, you will see there's just all negative numbers. But in case of sales, you will see that you are receiving some money back for all the properties that you sold. Okay, and then there's also a section for the debt financing here. So again, you'll see that first you will see a positive numbers, and then the negative numbers are your repayments that your principal repayments. And then here, in case of sales, you will see that those numbers here are those early repayments, and that allows you to calculate your cash flow, which should agree exactly, that cash flow figure should agree with the cash flow model summary above. Okay, now that leads you to your balance sheet. So as I mentioned, because it's a real estate model, you will see that your assets will be quite a substantial part of the balance sheet. And you'll see that here, for example, where I list the stock is the so this is the value of the properties that are built for sale. And then you see that there was a housing properties. So those will be your long-term assets, and their value is then offset by depreciation. Okay. Also, you'll see that your debt is included in here, and any investment, equity investment, which will be a result of the calculations just below. Again, the most important thing in the balance sheet, you just have to make sure that your assets equal your liabilities and owner's equity. So always include that balance check here. It's always nice when it works. And then finally, the model gets here to equity investment analysis. So this allows you to estimate the level of equity that you need to inject into the model. Remember, we put some debt financing, but that still had the cash flow still had some deficit, which has to be filled with some external investment. So you see that in here, what the model does, it simply takes your cash flows for operations, investing, and the debt financing, which are the figures from your cash flow statements. That allows you to show that cash flow before equity investment. This then allows you to calculate, okay, the level of the cash that's required based on your cash balance, and then that calculates the level of equity that you need to invest into the business. And finally, those equity numbers are then used in calculation of returns and the net present value. So for instance, in here, you see that I listed all the equity invested over years. And then in the final year, I'm collecting the value of the business. So the model assumes 5% yield in order to calculate the rent that you can charge to your tenants. And therefore, I'm also using a 5% here yield as my basis for valuation. So I simply take the gross rental margin and then divide it by the yield to give me my valuation. And then I adjust this figure to whatever cash I have on my balance sheet, but also to any outstanding short-term liabilities that I may have. And then finally, that big figure here, I'll also subtract the level of debt balance that I have on my balance sheet. And that allows me to arrive at the final figure of proceeds that I would be able to distribute among investors if I were to, for example, sell the business. And then you will see here, I've linked my IRR calculations and my return calculations to my equity investments and those exit proceeds, as well as the net present value calculation. Okay, now with all those figures and the output of the model, we can go back to the beginning of our summary here. So you see that I've listed my equity requirement and the return calculations here on the top, which then should make it relatively easy to run any sensitivity analysis or stress test the model. Okay, so for example, let's say that we want to see, okay, what will happen to my returns if I were to change the level of debt that I can inject into the model. Okay, so for example, at the moment, I'm assuming I can fund the model with 80% of debt. Let's see what happens to, for example, my equity requirement and the return if I would change to that figure to 65%, right? So you see that, which is expected because I cannot finance the model with as much debt as previously. I have to put more equity in that. And then you also see that, for example, that affected your returns. Okay, let's go back to 80%. Yeah, and then you can, for example, take another figure. For example, that yield. Yeah, remember that the yield determines the level of rent that you can generate from the properties. So let's say that you go into a market that actually historically has always low rental yields. So let's see what happens to my returns here if I were to decrease my yield from 5% to 4%. So you see the returns went down from just above 9% to 5.6%, but also your equity requirement went up. Okay, let's go back to my previous assumptions. You see there was a 9.6, 5.4, which was the assumption before. For example, let's see what happens if your build cost is higher. So, for example, you will increase your build cost by even 5%. So, for example, from 200,000 per building to 210,000 per building. Yeah. Again, you see that your returns went down and also your level of equity requirement went up. Yeah, which is again expected because you just have to spend more money for a build while keeping everything else constant. And in addition to that, you also will see that the model has investment calculator, which allows you to calculate, for example, your payback periods. So how long it's going to take you to pay back your investment in number of years based on assumptions in the model. And then finally, going back to the summary, I've also included to the right some Excel data tables, which simply allow you to test some of the scenarios. So going back to what we did a few minutes ago, where we tested a few different scenarios and see how they affect on, for example, equity, investment, or internal rate of return. You can set those data tables. So for example, here I'm testing my equity requirement for different interest rates. So I want to see, for example, how my equity investment changes depending on the interest rate. And then here in column, I'm using the assumptions for property cost build, which is again something that we tested before. So you can, for example, see if I were what will happen if I were to set the property cost for $220,000, and then let's say set the interest rate to 6%. So you see that how that increases my equity requirement. And then below here, for example, I can see, okay, what will happen to my IRR, so my returns under those assumptions. Okay, so this is a neat way to stress test your model and then find any weak spots in your forecast.
I hope you enjoyed this tutorial. If you have any questions or if you'd like to download the template used in this video, follow the link, which you will find in the description, or visit my website at www.challengejp.com. Thank you very much.